Welcome back. You're watching Business Morning on Channels Television, and on the program today our focus is on the implications of the monetary pronouncements on the investments into the country. I've been having a conversation with a professor and head of the economics department of the University of Lagos, Ndubisi Wokoma, and Mr. Johnson Chukwu, who's the Chief Executive Officer of Kari Asset Management Limited. Thank you so much, gentlemen, for sticking around.
Thank you.
So just before we went on that break, I said when we come back, we'll look at how the federal government's drive to ensure that we have more foreign direct investors coming into the country. In fact, just yesterday, the NIPC, Nigerian Import Promotion Commission, actually met with some members of the diplomatic community to see how we can increase foreign direct investments into the country. But from the last couple of minutes conversation, it looks like at this particular point in time, that's not what the federal government should be focusing on, increasing more foreign direct investment. Professor Wokoma.
Yes. FDI, it's desirable for many countries, and when you have an increase in interest rates for a country, capital all over the world will go if the rate is attractive. That's theory, the theory of it. If you have the rates in Ghana compared to the one in Nigeria higher, what they will do, capital will flow from all over, from Germany, from wherever. And when you have high cost of funds, and interest rates will now go up, and the return on capital comparatively will go up in Nigeria. Definitely, by theory, we should expect an inflow of FDI. And that is what we'll expect. I said theory will be there, but we will follow through and see the system. The environment has to be conducive for them to come. And it also depends on the kind of investment they're coming in, with. Is it short term? Is it something, coming in to invest in fixed assets and all that? What kind of thing are they bringing in? And that's an area that we have to also look at. But technically speaking, when you have increase in your interest rates for the economy, you will expect more inflow. But there's something that has been happening over time, and the recurring in various symposia. The issue that Africa as a continent is bleeding. There's so much illicit capital flowing out of Africa that if the FDI will just be a speck, a drop of water in a big bucket. If we compare it to the outflow of capital from Africa, it's a very, very critical. It's another discussion entirely, which is quite loaded, which has been, looked at by the African Union. That Nigeria as a country will have a lot of bleeding of capital. That and people have said that we bother so much about FDI because if you look at the quantum of outflow of capital, money laundering, tax evasion and other sorts of, try to misprice trade and all that is taking place all over the country, partly through, and also money laundering. If we're able to address that issue, we will not be bothering so much. And Africa is a net exporter of capital to the world, compared to all these FDI. So that's an issue, but technically speaking on paper, we should expect FDI to flow in. But what happens in practice will not be another issue entirely. Also, the environmental grant created to make it happen.
Well, thank you so much, Professor Wokoma. Now, Mr. Chukwu, just yesterday in Abuja, the Minister of Finance, Dr. Ngozi Okonjo-Iweala, says among the many things that the ministry is going to be reviewing is the nation's policies on investment incentives, waivers, and tax exemptions. Do you think if they get it right in the short to medium term, that will kind of also affect the amount of foreign investments that we're expecting to come in? Because, right now, a lot of people feel that now is the best time for foreign investors to come into the country.
Well, I would look at it not just from the foreign investors' point of view, from even entire investment climate. I am happy that she said that. If you see the theme of my discussion, it has been that we need to use monetary policies and fiscal policies to stimulate local manufacturing, local productive activities. And I'm happy, if you look back at what we have done so far, under the Obasanjo's government, they introduced the cement master plan, cement industry master plan, and they used incentives. And what incentives they used? They granted them tax waivers. They gave them licenses to import bulk cement for a temporary period of time. And they insisted that for you to get that license, you must have a manufacturing station. And you found out that because of that, a lot of people who went to cement manufacturing, cement importation, had to go and do a backward integration to set up cement manufacturing companies. We have moved from a 2 million metric tons per day of annual production, 2 million metric ton annual production, to 28 million metric tons today. And today, Nigeria is going to be a net exporter of cement. That's the tool you can achieve, the kind of success you can achieve using fiscal policies. They've also introduced something in sugar. And we're seeing Flabis of Nigeria, Dangote Sugar, Bua Sugar, several of them going to set up backward integration, going to set up farms for sugarcane plantations. Basically, in the next couple of years, we are going to be dependent of sugar importation, and maybe we're going to export sugar. The government has also introduced a same policy in automobile. So the key thing is that the government should use fiscal tools as well as monetary tools to stimulate local production. You don't go cap in hand and beg foreign investors to please come and put money in my country. It doesn't happen. You create a climate that make it compelling to come to your country to invest. And that's what I think we should do. Let's use the monetary policy. The monetary policy, like I said, that I don't totally agree that they have used effectively well at this time when they're increasing exchange rate, is the issue of increase in cash reserve ratio on private sector deposits, because you don't shorten credit. Let me tell you, what did the US do? When we talk of quantitative easing in US, quantitative easing was a situation where government were buying up assets to inject liquidity into the system so that the banks can lend at very cheap rates. So that banks can lend at cheap rates, so stimulate consumption, stimulate production. We need to, once you have a huge population, you cannot but have an economic framework that supports local manufacturing. And finally, before we go, I want to mention one aspect that the government is trying to do, which is, I'm happy that Professor Wokoma did mention, that over time, several years, right from the time he was in school to the time I was in school to now, that people have continue to talk about whenever oil prices drop, Nigeria goes into a crisis. And Nigeria consistently for the past maybe 40 years, since the advent of the military government in the 60s, and we moved away from regional government, for the past 40 years, going to 50 years, we have depended on oil for about 95% of our imports, our foreign exchange earnings, and 80% of federal government earnings, revenue. You need to address that. We need to address the problem from the two pivotal ends, and that is the demand and the supply. The demand aspect will come from import substitution industries. Encouraging import substitution industries so that, like I said, in the case of cement, sugar, and all those things, we stimulate local production of these goods so that they will displace the goods we're importing. Then on the demand side, on the supply side, we need to broaden the economic base, which also tells you the same thing of stimulating local manufacturing, so that we begin to export products beyond oil, crude. And those factors we must address if we do not want to go through the same cycle. We went through it in 2008, we're going through it in 2014, and who knows, maybe in 2020 we will go through it again. I think the key thing that we need to address those fundamental issues. We should have an economic policy that is overriding purpose is to drive local manufacturing of goods.
Professor Wokoma, you share the same view as well?
Yes, I think we need to be prepared for such shocks. They keep on happening from time to time. I think government should be able to focus more on the non-oil sector. It's very, very important. We have been saying it, singing it and all that. We need to actually focus more on the non-oil sector and be able to generate good for the economy. Unless we do that, you call another set of people again to come maybe 2-3 years down the line to come and discuss the same issue. Well,
hopefully we will not have to.
We are hoping so.
Well, thank you so much, Professor Wokoma, for coming on the program, and Mr. Chukwu, thank you also for sharing your thoughts with us on the program.
My pleasure.
Well, we've been looking at the implications of the monetary pronouncements on investment into the country, and I've been having a conversation with a professor and head of economics department at the University of Lagos, Ndubisi Wokoma, and the Chief Executive Officer of Kari Assets Management Limited, Mr. Johnson Chukwu. Well, thank you so much for being a part of today's program. It is the last edition for the month of November. That's it. I'm Harriet Agbenyi. I'll see you in December.